Is it smart to pay loan discount points to buy down your interest rate when you're buying or refinancing a home? That's probably one of the most common questions that I've received over the past 25 years. And the answer, as it often is, it depends. Today I'm going to show you some of the math so that you can make an educated decision based on your own personal circumstances. I'm also going to get into exactly how much you'll save or not save when there's a difference to your interest rate of 1/4 of a point. So first, most folks think that a 1/4% higher or lower interest rate is going to result in more savings, or lack thereof, than you'll actually get. Let's take a look at an example using a loan amount of $350,000 at a 30-year fixed rate of 6.75%. The payment, $2270.09 per month. That's just principal and interest. And now let's look at the same loan amount and term, but with an interest rate of 7%. The payment is $2328.56 per month, principal and interest. So $2328.56 minus $2270.09, and your phone rings, is a savings of $58.47 per month. Yes, over time, $58 per month can definitely add up, but most homeowners are surprised to hear that it's less than $60 per month when it's a 1/4% lower interest rate. Well, let's say that rates are 7% and you absolutely are not going to buy a refinance unless you can get a rate that's below 7, let's just say at least 6.75%. So let's talk about whether it makes sense to pay points to go from 7% to 6.75. Contrary to popular belief, 1 discount point does not equal 1% lower interest rate.
No, no, no.
Typically, 1 discount point equals 1/4% lower interest rate. So using the same example, a loan amount that's $350,000, if today's rates were 7% and you paid 1 point, that means you'd be paying 1% of the loan amount, or $3,500, to buy down your rate to 6.75. Doing so would save you $58.47 per month. Should you pay $3,500 to save less than $59 per month? Maybe. It all comes down to how long you're going to be in that loan. And here's how the math works. You simply take the total cost of $3,500, divide that by the monthly savings of $58.47. That gives you $59.86, which represents the number of months it would take for you to break even. To make things easier, let's just convert those months to years. $59.86 divided by 12 is 4.99. So let's just call it 5 years. So as long as you're confident that you're going to be in your loan for at least 5 years, you wouldn't lose any money by buying down your rate, and your payment would be roughly $59 per month lower. But let's look at a different scenario where instead of using that $3,500 to buy down your rate, you invested it into an interest-bearing account that earned, let's say, 6%. $3,500 invested at an estimated rate of return at 6% after 5 years would turn into $47.21. So you'd actually make $1,200. So does it make more sense to save $59 per month on your mortgage for the next 5 years, or would it make more sense to invest that money? There are other variables to consider, such as the interest write-off for actually paying for those points. But the answer to that question is one that only you can answer based on your individual circumstances. But pretty much any financial advisor that I know would say, if you can afford your monthly payment being that $58 or $59 per month higher, you should instead invest that $3,500 into an interest-bearing account as opposed to using it to buy down your rate.